Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. For those of you who are new, welcome to the Daily Gold YouTube channel. Thank you so much for joining us on this Good Friday. This video is being recorded on the early evening of Friday, April 18th, 2025. Well, a happy Easter weekend and a happy Easter to everyone out there. And I spent a lot of time on this video. We are at an interesting juncture here. There's a lot of nuance to this analysis. Look, gold is glittering. Gold stocks too, at least most of them, not all of them. But the gold segment of precious metals is glittering, but it looks like we could be coming to an interim peak here. And so what does that mean for gold and the gold stocks? How's silver going to perform? Is silver and the gold stocks, are they really going to sell off significantly here if we have a correction? A lot of important things to get to. So this is going to be a long video. I've got a lot of charts. So let me, without belaboring the point, let me get right to it for you guys. Okay, so as we always do here, let's start with a market overview. I love these candle glance charts from stockcharts.com. Beautiful 2-month candle charts here. We can take a quick look at many markets here and get a sense of how they're trending in the short term. So as we can see, these all ended on Thursday. So look at the last 4 candles for the week. You still had gold up on the week, silver up a little bit too. Actually, now that I recall, GDXJ was up almost 5% on the week. GDX up about 2.5% on the week. The silver juniors were up, at least SILJ. I think this was up about 1%. I think SILJ was up almost 2% on the week. But looking at gold, gold was up almost 3% on the week. So that's the glittering factor. Silver was up, I think, about 1% on the week. With respect to the miners, we can see the gaps here. I mentioned these last week. On Thursday, almost filled this gap on Wednesday. But a market has had a really strong run. So here you can see TLT had a nice rally, but the stock market was actually down on the week. So that's where we are. But this aside, there's more interesting things I want to talk about with respect to the week. So this is a point where we really need to understand the big picture. Because yes, gold is really overbought. It's showing some similarities to how overbought it was in 2020 or 2008 or 2006 and those other periods. But we need to add the context of where we are from a 40,000-foot view. And the context is gold a year ago, 13 months ago, broke out from a 13-year base. This is the most significant breakout in gold since this breakout here, which was the biggest breakout of all time. This was a 100-year base in the $40 range. That goes back to the Civil War. And what happened? Boom, you had a huge bull market. Now, also, you could point to this breakout here in 2005 as significant, although this was coming off a bottom, so it wasn't at all-time highs. And so when a market breaks out like this around all-time highs, as you can see here, you have a lot more momentum, you have a lot more power than breaking out here, coming off a bottom, and you're still below the all-time high. So I think those are the two breakouts that really compare, just looking at gold. But also, let's look at gold against a 60-40 portfolio and gold against the stock market. Because people can either put their money in stocks, bonds, or gold, or other commodities. Those are the 3 major asset classes. And so these secular bull markets in gold and precious metals, they were triggered or confirmed by this huge breakout here, this breakout here, and also this move here above the 40-month moving average. So this breakout, gold against a 60-40 portfolio of a 10-year-long base, is really, really significant. This is only the 4th time you've had a move like this out of stocks and bonds and into gold, 4th time in the last 100 years. Again, you had here 1930 confirmation, early 72 confirmation, early 2002 confirmation. And so you have it here. And this is what's happened in the last month, really in the last 4 or 5 weeks. You see capital is flowing out of stocks and bonds. I mean, really in the last 4 or 5 weeks, it's more so it's been stocks, as you can see here. So capital is flowing out of stocks, it's moving into gold. And this chart shows we've broken out of this kind of a base here. There's real potential for this thing to really run. Like, this is a significant breakout. So what I should have said is this tells us that this breakout, this has a lot of room to run. And that means a lot more room for capital to move out of stocks and bonds and into gold. So this is a much different situation than right here in 2008, where You already had 5, 6, 7 years of capital was moving out of stocks and going into gold. Same, you could say here, but same thing here. You were later in a secular bull. Gold had already made a huge move. Money was already moving out of conventional assets and going into gold for several years. So we have to keep this in mind with projecting where we are. And so I think the best comparison, we mentioned this breakout here out of this 20-year base, and now you have this here. It's probably the early 70s. To me, that's based on gold breaking out of the 60-40 here. I mean, that's the best comparison for where we are. So we have to keep this in mind when we're evaluating these interim peaks. But with that being said, we are coming into an interim peak in gold. And this is one sentiment indicator. So this looks at the dollar value of all the calls traded minus the puts. And so the put call ratio is a sentiment indicator where if you're buying a put, you're essentially betting against the market in some way. Some people use options to hedge. Other people use options to make an aggressive leverage bet. So the put call ratio is a really good sentiment indicator because when the market's going down, you see a big spike in the put call ratio. That tells you the market is close to a bottom. Now, this is looking at the opposite way. So more calls being traded than puts. That means people are optimistic and they're speculating. And so we can see here, look at where this indicator is, or look at where it is now and look at where it was here. I mean, this was the Russian invasion. Remember this peak here in 22. So here you have that peak here in 20 and you have this peak here in 2011. So this is telling us that we're coming into an interim peak. Now, think about the last slide and gold against the 60-40. That tells us we are not here or here. We're at a different point, but we are coming to an interim peak. And so another thing that I like to look at is the quarterly RSI. You can look at weekly or monthly RSI, but I like quarterly RSI because that allows us to quickly evaluate gold's history of, 57 years or, 55 years since we've been off the gold standard in this fiat system, which is going to die at some point, probably in the next 15 years, if you ask me. But we can see here, this is where the RSI is. This is how high we are. And let's look at here, the comparable points, 1979, secular blow off top. Here, 1973, you had a correction going up here. And by the way, a month or two ago, there was this peak here in 72. So gold corrected 13% here. This correction, I believe, was about 28%. I don't think we're at this point yet. I think we're closer to here, honestly. But you can see the other points where this was 2006 and gold consolidated. I mean, it corrected for about 6 months. It did consolidate for a little longer than that. Then you had the big move from 2007 into the 2008 peak. So these are, you also had here, this was breaking out past 1,000. So this was in late 2009 where the momentum was really high. So it's important to understand this and this right here. So we're in a secular bull market. And so what that means is momentum is going to be strong on a quarterly standpoint. Momentum is going to be strong for a while, and it's going to hold there until the secular bull market ends. So having really high momentum isn't necessarily a bad thing. But given where we are here and now, it means we're going to get a rest or some kind of correction in gold. Okay, I've talked about this before in past videos. And so then the question is, okay, well, how is gold going to correct? What's a potential bottom target? Where might it correct to? Historically, gold makes a major breakout, it runs, then it comes back and tests the 200-day moving average, or maybe it goes a little below or a little short, then it makes another leg higher. So you can see here, this was the first breakout, second breakout here. This is a 2006 one here. Actually, wait, you had another one here. This was 2003. So first, second, third, fourth here, fifth, sixth here. And so this was the seventh. And so if you look at all these other breakouts, you can see here, breakout, came back, tested. This was about a 14% decline to the 200-day. Boom. Here's the one in 1978. Breakout, sharp move higher, and then it corrected 20% in like 2 or 3 months, successfully retested the 200-day. You see the same thing here, in 2006. It went a little below it. Here, after this breakout in 2009, this didn't quite touch it. It was what came within 2 or 3%. The second line is when it did test the 200-day. Here's another example. I believe this was, okay, this was right at, you had the breakout here in July of 2019. And then COVID, it finally, after the COVID crash, it came back and retested the breakout. So there is a strong pattern here where you get a gold major breakout, makes a move higher, then it comes back and tests the 200-day. So the 200-day, based on where we are now, this is the weekly equivalent. So call it 2,700. I mean, we'll see it in the next slide. But, with respect to silver, these lines show when, the other 3 times when these breakouts were to new all-time high. So again, early 70s, late 70s, and then here, 2009. And so after these 3 breakouts, gold moves up, then it comes back and retests the 200-day. When it retested the 200-day, look at how silver performed. Boom, that move here, that move here, that move here. So, and look, all of these were breakouts, these moves in silver. Like it had to break here. If you go back, the 68 high was around here. So this was a breakout in 73. This was breaking out here. And then this one, this was a huge breakout when it was breaking above 2022 right here. So what's going to happen? We're going to see that correction. Gold will test the 200-day. What's going to happen to silver? It's finally going to break past 35, which we know has been a bitch for silver. This is a significant resistance. So that's what's coming up, I think, later this year. Okay, let's get to a gold and silver daily chart. I want to focus mostly on gold. So we mentioned it, the 200-day moving average. You can see it's here. It's 2698. So that will be 2,700 next week. But I've sketched in here, how do we think this will play out? That's my guess here. So the 200-day moving average in June, that's probably going to get really close to this line of support here, just below 2,900. You also have this line of support here, just below 3,000. And so in July, the 200-day moving average for gold should probably reach 3,000. Now, a move down here would be minus 12%. Maybe it'll come back a little bit more, but also maybe this is not the peak. Maybe gold has one more move to 3,500, and then it's going to come back down like this and correct, test the 200-day, stabilize here before it moves like that. Now, with respect to silver, the gold-silver ratio, the question is, are we going to see one more thrust up in the gold-silver ratio? Because if and when that happens, that's also when silver will make a low. So who knows how that could happen? Again, maybe gold makes one final move to 3,500 and silver kind of fizzles out here. And it comes back down here to the low 30s, and this is at 3,500, and that's how you get the gold-silver ratio here, making another pop like that. And like we talked about last week, when you get those big surges in the gold-silver ratio, it leads to lows in silver, but also peaks in the gold-silver ratio, obviously. And so silver will make a low, but also outperform gold from that point. So perhaps that happens before gold tests its 200-day moving average. But when gold retests its 200-day successfully, that's when silver will really take off relative to gold. And so these are the support levels I'm looking at here, just below 3,000. And before we get into the stocks, if you do own minors or juniors, check out our service at thedailygold.com/premium. All those who have joined, thank you so much. We appreciate your business. And those of you who own minors and juniors but have not joined, I think you should really take a look. We'd love to have you come aboard. And this, to me, this coming correction, this could be the last chance over the next few months to buy high-quality juniors at really attractive prices. Moving on here, let's talk about the stocks. So this is a very important observation here. And there's a real possibility that I think something like this could happen over the coming months. There were some points during other bull markets when gold broke out and made a huge move. And then when it corrected, the gold stocks actually outperformed gold. Silver actually outperformed a little bit. It was mostly in the gold stocks. And I think we're setting up where something like that could happen. And I want to go through some of the historical examples. So the two best examples are 2003 and 2009. And so we can see here, this is gold. And it broke out here just at the end of 2002. It goes above 300. This is 300 here. So breaking above 300 was a really big deal. Makes a big move here, but then it corrects, and then it basically consolidates before breaking out here and making a final move higher in late 2003. But during this consolidation, look at the gold stocks. So this is the Huey. You had it sells off with gold first, but then it trends higher like that. GDXJ, kind of similar. It sells off with gold, trends higher a little bit, has a pullback here, and then just shoots higher before gold breaks out. So you have this, you have this. By the way, this is data for my own junior index. And if you think about juniors, the history, juniors in 2003 absolutely surged. Like they killed it. You can look at the CDNX. It made a huge breakout. So that's why you had this type of move. And you can see silver. I believe silver started to outperform gold right around here because we can see, look, you can see here, gold had not moved above its 2003 peak until, you really had to get until the very end of the year. Whereas for silver, 2003 peak, and you can see here, started to move above it. You also see this. And then silver really surges. So 2003 is one example. Now, let's look at 2009. So remember, you had the 2008 low. Gold makes a huge move. I mean, this was like a 40% move where it shoots up to 1,000. And then gold consolidates for 4 or 5 or 6 months. It peaks here at the end of February or in February. Again, consolidates for 4 or 5 or 6 months. What happened to gold stocks and juniors? Let's look down here and we can see here's the peak in the Huey. It wasn't perfect, but we can see it corrected a little bit, but it trended higher here. This move here, it trended higher. And look at GDXJ, same thing, even stronger. So you had a stronger move here than the Huey and the large caps. I mean, this was a really strong move while gold was consolidating. Silver, not quite as strong, but it did outperform gold. Like we can see here, look, it's trending like that as gold is basically going sideways. And I think we are setting up for that to repeat, where gold is going to make some kind of peak in the next week or two, and the first sell-off, the first move down in gold, silver and the gold stocks and juniors, they will get hit. But after that, gold will stabilize and probably consolidate. And at that point, that's when you'll see miners and juniors, they'll trend higher from that point and outperform gold. Silver, I mean, there is a lot of nuance to that because it depends on the gold-silver ratio. If you get a real spike move before gold peaks, silver could make a low at that point. And so it could also outperform gold during the gold correction and consolidation. But at the same, here's the nuance again, at the same time, that $35 resistance in silver, that's really significant. So we'll see. But I think we're setting up for a repeat. And by the way, another reason why we could get a repeat, and this is not a perfect similarity, but 2003, 2009, those came after market bottoms. And I think the stock market, we could have a bear market rally here for a little while. And so a bear market rally while gold consolidates and corrects. Okay, this is getting long, but I still have some couple of important insights here. Okay, so here's GDX. And here are the breadth indicators. I've talked about this before. New highs divided by new lows. It's a percentage. And you can see here, this shows where we peaked. This is 36% in 2016. This was 33%. Or 34% in 2020. Look where we are now, 28.5%. So we are getting close with the stocks to an interim peak. This wasn't the case a week or 10 days ago. So we are getting close. Now, again, there's more nuance here. If you look at this indicator, going back to the early 2000s, the various interim peaks with respect to GDX, and I can't share this data publicly, but if you look at the interim peaks in this data, they're at similar levels in the early 2000s. So just because this makes a peak here, that does not mean that, oh, we're right here and the market's going to do this, or we're at 2020, or we're right here and the market's going to crash. It's just telling us we're probably going to come up to an interim peak of some sort. And the market's going to rest for several months. And so what does that mean for the miners? I mean, we just had this in the last month. We had this breakout, then we retested, and then we shot up. We had a 20% gain a couple weeks ago. That could mean, well, they have a last burst higher. There's some more buying. Maybe if gold's going to shoot up, maybe the miners shoot up a little bit more. And then they could come down and correct 20% down to close to these support levels. And based on what we were saying here, you get the first leg down in the stocks, then you move up, like you can see it here. This peak here, this peak in gold, first leg down. After the first leg down, you had a strong move higher. First leg down here, strong move higher. First leg down here, strong move higher. Okay, let's talk about that more. So let's look at the short-term charts. You can better see here. So a retest of the breakout, that would be here, like around 42. So you can see the gaps here. One of the gaps already filled, but that's a potential downside for me. Is this support level here at GDX, 42. For GDXJ trade as high as 66. So you have 52.5, 54 here. So these are the support levels to keep in mind. 200-day moving average here. I mean, this will come up like this. Same thing here. And so the miners could come down and test the 200-day moving averages. So that's it for the video. This was really long. I thank you for staying with me until the end. And hope you have a great Easter weekend, great holiday. And I'll talk to you guys again in the next video. Thank you.